My humble greetings to you, traders. Welcome to today's installment in this YouTube channel. And in this video, I will be introducing to us the logic behind the concept liquidity in the market. And if this is the first video you're watching in this channel, you're a little bit way ahead. You might want to go back a little bit to the previous video where I laid the foundation on liquidity in the market. I laid the foundation and explained the core concept behind liquidity in the market. So you may not understand clearly and completely what we'll be discussing in this video. So I would like you to pause the video and refer to the initial one, then come back. The video is always here, it will be deleted. I tagged this particular video to be Understanding Liquidity 102. The initial one which I am referring you to is Understanding Liquidity 101. Liquidity is a very vast concept and it can be compressed into one video. So you might want to go back and watch the video. That way you will understand whatever we will be discussing in this particular video. So let's move on. So if you make it to this video, then I will congratulate you. By now you would understand that liquidity resides at every swing high and every swing low. So every swing high and every swing low in the market is a potential liquidity pool, just like the swing high here and the swing low here. So in future time, we expect price to trade above the swing high and to trade below the swing low, just like we can see here in this market. The market took out the liquidity above here and drive price to take out all the liquidity that is resting below here. Now this liquidity is money in the market, and money is the only thing that drives this market, not buying and selling pressure. So I wouldn't want to nag about that for so long. I would be introducing to us the other liquidities that reside in the market. So as a trader, it will interest you to know that liquidity is the primary reason why price moves and dance around and you see or think that it is a random market. No, it is seeking for liquidity in the market, and liquidity is everywhere in the market. So liquidity is the main reason why price moves from a swing low to a swing high and vice versa. And another thing I would like to bring to our notice is volume. Volume is a result of a large amount of money being pumped into the market, just like we can see here. There's volume was pumped. A large volume came into the market, which resulted to a sudden decline in the market. You can see this market dropped suddenly. It is just selling with less opportunities for buyers to participate in this market. So this volume also caused inefficiencies in the market. These inefficiencies are gaps that are left as a result of the large volume coming into the market. So when the market is all selling, just like this, market is all selling, these bearish candles, you see that this swing is all selling with less buying. So when market is all selling, it results to gaps being left in the market. Gaps like here, there's a gap here. There's a gap here. Okay. There's a minor gap here. So these gaps are imbalances, and these imbalances is as a result of volume coming into the market, which made the second participant in the market not to participate efficiently, and the market would not deliver efficiently, which it's supposed to deliver. The market is supposed to buy and sell, giving the two participants opportunity to play in the market. So these imbalances is formed by three candles. These imbalances are formed by three candles. When we consider three candles, I will take these 3 candles for example. This is the first candle, this bullish candle, this bearish candle, and the third candle. This gap is formed as with 3 candle formation. So when volume comes into the market, you see market deliver one side and giving less opportunity for the other participants to participate in the market. So to look for the gap, we look for the high and lows of these 3 candles to see if there is an overlap around the area. So we consider the first candle and the third candle to see if there is a gap in the middle. That's the second candle. So if we consider this first candle, where do you think the low is? Of course, this is the low of the candle. I will draw a line there so you can all see. This is the low of the candle. And delete this arrowhead. Remember, we are considering this candle, this bullish candle, this second bearish candle, and this third bearish candle. Let's forget about every other candle that are in the market. Let us focus our eyes here, here, and here. Okay. Now, to find this gap, we consider the low of the first candle and the high of the second candle to see if they are overlapping. And what do I mean by overlap? If they came together, if they touched each other. You can see the low of this candle and the high of this candle didn't meet. There is a gap, there is a space between them. These are the imbalances in the market, and these are liquidity as well in the market. Okay, so we'll consider this low and the high, and see this impulsive candle. This one-sided candle shows a sell-side delivery and buy-side inefficiency. What do I mean by buy-side inefficiency? It means that buyers couldn't participate enough, couldn't drive price up above to this low, to this first candle's low. Buyers weren't given opportunity to move price up a bit, then continue lower. So these gaps are liquidity in the market. So when this gap forms, we believe that price will eventually trade into this gap to cover up all the spaces that is left here. Hence, this space, this void is seen as an imbalance. It's seen as an imbalance or a liquidity pool. Price is going to come there to fill in those gaps. Then, when price comes to fill in those gaps, it is regarded to be efficient or efficiently delivered. Price will then continue probably going down or continue going up. So when these gaps are created, we have it as a smart money trader, we have it at the back of our mind that price will eventually come into it to balance those imbalances. It may come the first time to balance it, but not completely. But it will also come in future times to balance it all completely. Just if I draw this line, if I extend it a bit, we can see price eventually came into that imbalance to fill it a bit. It didn't fill it completely. The market is supposed to trade into the low of the first candle, this particular bullish candle. The market is supposed to trade into it completely to fill in all those gaps. But for this case, the market didn't fill it completely. It just filled a bit. This little wick here, you can see this little wick here, it traded above the high of the third candle, but it didn't get to the low of the first candle. So the idea that I'm trying to share with us is that price will eventually come into this gap to fill in this gap in future time. So these are liquidity pools, these are liquidity areas where price will eventually trade into. So you can go to your chart and backtest it to see that truly this gap is created all the time. Let me show you another example. If I take this candle, this particular candle, this bearish candle. Okay, this particular one, the second one, and the third one. Adjust the second one so you don't confuse us. This. Okay, this is the first candle we are considering for now. This is the second candle. This is the third candle. Alright, now I'll delete the arrow since we can identify the three candles that I'm hinting out. You see the high of this third candle. This is it. I've drawn a line across it, and the low of the first candle. Okay, this is the high of the first candle, or you could call this the first candle, either this or this, so I interchange them sometimes. So this is the first candle, this is the second candle, this is the third candle. The idea is to identify three candles and look for gaps that reside in the middle. So this is the gap. We can see the third candle high didn't trade into the first candle's low, so there is a gap created there. Now the next candle, we believe that market will, or price will, trade into the gap in future time, then continue in the direction it wants to go. So since we can identify this gap, we believe that market is going to, the price, market or price will buy into this gap to fill it in. This way we can create a bias to be bullish, or we could expect price to drive to the upside. So now we can see that the market eventually traded into this gap to fill in those gaps. Alright, this gap, the market filled the gap here in this candle. This particular candle filled in the gap. Let me scale down to 15 minutes time frame so we can see this properly. Alright, this was the gap. This gap we saw it in 1 hour time frame. Now I have transposed it to 15 minutes time frame. Okay, this is the gap. The market eventually came to fill in those gaps, then continue lower. Alright, so gaps reside everywhere in the market. We can also see this one, this candle, okay, and this candle. Okay, let's regard this as the first candle, second candle, then the third candle. You see how price traded into those gaps to fill in this gap that is created here, then drop lower. So gap residing everywhere in the market, and this gap are liquidity. So with the help of this, with the help of the understanding that gap reside in the market, we could deduce that market or price will eventually trade into those gaps to fill in those gaps and continue the direction it wants to go. So these gaps are liquidity, and it helps to move price up and down. Let me go back to 1 hour time frame and show us something else. Okay, delete this and this. See the gap that I drew out initially the first time. This gap here, this is the second gap, this is the third gap. You see how the market eventually came to fill in all those gaps. Let me draw this out. It filled this gap, and this gap, and this gap. Okay, it didn't fill in this completely, but in future time it will drive price above to fill in all this gap. All the gap in the market will eventually get filled in future time. So this gap are liquidity in the that resides in the market, and it helps to move price up or down. So we could use these gaps to our own advantage, and I'll be explaining how we can use it to our advantage in no sooner time. So this gap will eventually get filled in the future. So if I extend this gap to the other side, you see how price trade into it handsomely to fill in the gap. Okay, it failed to fill it here. It dropped lower, but eventually came to fill in the gap there. Remember, we're considering the high of the third candle and the low of the first candle. Okay, we'll consider the high of the low of the first candle and the high of the first candle to look for gap. There's a gap residing here. The market failed to fill it in here, eventually came to fill it in here. So essentially, the market will eventually fill in all the gaps that it creates when volume is released in the market. So this gap resides everywhere in the market, and it is not only limited to the sell side delivery. This gap is regarded as sell side delivery, buy side inefficiency. So which means markets will eventually move to the upside, buy in order to fill in those sell side, buy side inefficiencies. Now we can also look for the gap that resides here. Okay, this gap is regarded as buy side delivery, sell side inefficiency, which means sellers were given less opportunity to participate in the market, which means price will eventually come down to fill in the gap, then continue its original direction. You see, this is the gap. We'll consider the high of the first candle, then the low of the second candle when we're looking for sell side inefficiency. But when we're looking for buy side inefficiency, reverse is the case. It's just turn the concept upside down. We'll look for the low of the first candle, then high of the second candle. You might want to rewind the video to understand it. So you will have to watch the video over and over if you're having difficulty in understanding it. Eventually you understand it. It is a very sweet and simple concept. You see, this gap is everywhere in the marketplace. You can find it everywhere. You can just go to your chart and draw out all the gaps that you can see and look for how price trade into it handsomely. This is another gap here. This is another gap. Look for 3 candle formation, look for the gap there, and wait for price to fill it in. Okay, this is another gap there. Look for this first candle, second candle, the third candle. Is there a gap between the highs and lows? Yes, there is a gap here. Price dropped into the gap, then fully, and also continued higher. It's also here. I can go ahead and show you all the gaps in the market. It's fun. This is another sell side inefficiency, buy side delivery, fair value gap. The fair value gap acronym is dubbed or was dubbed by ICT, the inner circle trader. He propounded the word fair value gap, but the logic resides in the market even before anyone started trading. This is the signatures the market leaves for us to understand. These imbalances reside in the market. These are fair value gaps, just like ICT will call them. These are gaps that reside in the market. These are liquidity pools. This is another gap. This is another gap. This and this. Okay. Volume came into the market right here, and price dropped aggressively, creating gaps. This is a gap here. This is a gap there. Okay. Price didn't fill it completely, but look at a nice fair value gap here. Imbalance. The low will consider the high of the third candle and the low of the first candle, and you can see the market drive into the gap for the first time, drop, and eventually the gap was filled right here. Completely. Okay. Delete this. You can see how the market filled in this gap the first time. It didn't fill it completely, drop and fill it completely. So what I'm trying to show us is that these gaps reside in the market, and it is everywhere, and these are liquidity that resides in the market that helps to move the market high and low, up and down. So you can see that this market doesn't turn from where it turns randomly. If you look for the reason why this particular swing high move from here to here, it could be as a result of the market seeking for liquidity above old high, or trying to balance an imbalance. Alright, this is a high, this particular high, this is a high here, this particular high, this is a high. So for price to run the high and turn from there is as a result of the market seeking for liquidity that resides above this high, this particular high. Okay, or the market is trying to balance an imbalance, this imbalance that we highlighted here. The market is trying to balance those imbalance, fill it completely, then turn. So this is not buying pressure or selling pressure. There is no, our money cannot move this market. This is as a result of the market trying to fill in imbalance or grab liquidity that resides above swing high and so with that being said, I believe I've been able to convince you, to show us that this market is not random. It actually seeks for liquidity that resides above swing highs and swing low, or balance and imbalance, just as I have showed us today the concept behind this imbalance by looking for 3 candle formation, find the gap that reside there, check if there is an overlap between the swing high, the high and low of each candle. If there is an overlap, then there is no imbalance there. But if there is overlap, then there is an imbalance there, and price is likely to trade into those areas, then deliver price efficiently. So this is just understanding the concept behind liquidity 102, and in the next video I will dig deep even more to let us understand the concept behind liquidity. There is more to this liquidity, and understanding liquidity alone, you understand the market, because liquidity is the market. Liquidity is the only thing that moves the market. The market will only go where the money is, then go the other way if there's money residing the other way. So money is the only thing the market seeks. So I would like you to dig into your chart, look for all the imbalances that you can find, check if price actually traded into those imbalances. If not, then expect price to trade into those imbalances in future time. And with these, you are heading somewhere as a smart money trader. So like the video, subscribe to the channel, toggle the notification bell so you know when I post another video. Stay posted.